everyone. Welcome back to Signal or Noise, Episode 7. Charlie Bilello, Peter Mallouk. And Peter, second half of 2023. Can you believe we're here already?
Lightning speed since COVID. Everything moves 10 times as fast.
Yeah, here we go. Well, second half is here. And the first half, a lot of surprises. And I'm going to run through a few of the biggest surprises that we've seen in the first half of the year. I think it shocked a lot of people that not just a few of these happened, but all of these happened. First of all, obviously the recession never came. Then we had the incredible comeback in markets. As of yesterday, S&P 500 up 20% year-to-date total return. Nobody had that on their prediction list. And then if you said the S&P was going to be up 20%, you certainly wouldn't have said that would have happened with the second, third, and fourth largest bank failures in history. And also a more hawkish Fed than expected, hiking 3 times. I think people were thinking just 2 times coming into the year. And now the Fed is expected to hike again next week. Then you have inflation. This is a good thing, good surprise, coming down to 3%, which is, I think, faster than people thought. Housing market resiliency, earnings actually recovering. We talked about all those efficiencies that companies were getting. Well, that's translated into better earnings. AI mania, and we're going to talk a little bit about AI today, and big tech making a huge comeback, growth, huge comeback, the travel boom, and really the rising tide that's lifted all boats with the exception of commodities, every major asset class higher this year. So I'm going to give you first my take on the biggest surprise for me. With the stock market, to me, nothing surprises me because I've seen just about everything. And the fact that it's up 20%, yes, that's more than people expected, but well within what we've seen historically in terms of volatility of movement. What shocked me, though, is what's happening this year in terms of the housing market, where we have the 30-year mortgage rate coming back close to 7%. We have housing affordability in the tank, pretty much the lowest housing affordability ever. And what's going on here is prices aren't coming down because supply has collapsed. So we've seen a collapse in demand. We had another reading on existing home sales today showing very little activity, but supply is coming down just as fast. Redfin showing the lowest level of homes for sale on record. They have data going back to 2012. So to me, this was really surprising. I expected home prices to come down more simply because when they're unaffordable, how did they become more affordable? Well, prices come down. But supply and demand always win at the end of the day. And in the short run, that's keeping prices down. If we look at the Case-Shiller, less than 2%. And so out of all these things, Peter, anything stand out to you in terms of something that's really shocking that's gone on in the first half of this year?
I'm with you on housing. And housing is such a tough nut to crack because when we were coming out of COVID, people weren't building. And then we had supply chain issues and soaring demand. So lumber prices were high. And so people just, again, another reason to stop building. And the Fed's fighting inflation and raising rates, which you figured would slow things down. But there's less supply coming on the market. There's more demand as millennials get older. And then when the rates go higher, what happens is a bunch of people don't sell their homes because they've got these 2-3% rates. They don't want to sell their house and go buy a house at a 6% rate, interest rate, mortgage rate. So they hold their house, which further constricts supply. So there's just so much happening there. And then you throw on top of all of it the institutionalization of housing with companies like BlackRock coming in and buying houses and renting them out. I mean, all of that together, it's just been a very hard recipe for economists to really figure out what's going to happen. And that's why this, to me, is so surprising. And I think eventually we're going to hit a tipping point where people start to come off these variable rates and things will look very, very different if things don't change between now and then.
Yeah, agreed. This is certainly not something that you want to see affordability at these levels. You want to see housing to be broadly affordable. You don't want people to be spending in an economy a huge percentage of their income on a home. Right? It crowds out other spending. It crowds out saving and investing. So we need more homes to be built, but it takes time for them to be built. And the strangest thing in the world, and I certainly didn't anticipate this, was that higher interest rates, yes, it crushed demand, but it also crushed supply. So it was really, I guess, a gift, you could say, to all those people who got mortgages below 3%. Maybe we'll never see that again in our lifetime. I don't know. Perhaps we will. But those people are not giving that up, right? And even if they wanted to, they probably could not buy the same home they're living in today if they were forced to do so at that interest rate that's more than double, right? So it's this kind of a strange dynamic here. I have no prediction of where it's going to go other than that if we don't see mortgage rates come back down, let's say they stay between 6 and 7%, it's hard to see how this dynamic is going to change. We're seeing home builders start to build more homes, but again, that's going to take time, and hopefully that comes. And we need way more housing, as you said. After the last financial crisis, we had housing starts just plummet, and building did not recover for a number of years. But at the same time, you have population growing, you have households forming, and now we're at the point where we have this huge deficit of homes even before the situation with the interest rates, and now this is just exacerbating the situation. So big surprise. We'll see what happens from here. Certainly, the second half of the year is going to be filled with a lot more surprises to come. And no, nobody, unfortunately, can predict those in advance. So let's switch gears here, talk about the hedge fund myth. This is what I call the hedge fund myth. And what is that myth, Peter? You've heard this before. What do they promise? They promise you high returns, low volatility, low correlation, and downside protection. You're going to get all of that from your hedge fund exposure. And it's supposedly something that is going to help investors in their portfolio. But what have we seen, particularly in the last decade, is just the opposite. Morningstar had this pretty good study going back to actually 1998 of multi-strategy funds. So these are liquid alternative funds, and taking the whole category, so all different types of hedge funds, and comparing them to a simple balanced strategy. So a Vanguard balanced fund, which is usually like 60-40 stocks and bonds. And what they found is just a huge gap, particularly in the last 10 years, between that balanced fund and the overall multi-strategy group. And I'm sure this is not surprising to you, but how do you think about the whole hedge fund ecosystem and the idea that the reality doesn't meet what the selling pitch is here whatsoever?
Yeah, hedge funds, protection against the downside, lower volatility, better returns. But the reality is, it doesn't matter if you look 10 years, 20 years, 30 years, the majority of hedge funds, the story is the same. You have guaranteed higher fees, guaranteed higher taxes, and a very high probability of underperforming a buy and hold a bunch of indexes approach. There's such a big gap between the advertisement and the reality. It's stunning. Now, you see hedge funds close all the time because they when they don't deliver, they can't collect the funds to be able to make the money they want to. And even when we don't account for that, all those funds that are closed, even the current batch as a group dramatically underperform a 60-40 or 70-30 portfolio. The hedge fund world is, for the most part, a loser's game. There might be one or two or three that outperform persistently, and that might even be a stretch.
Yeah, I think that they're certainly out there, and my biggest take with the hedge fund industry is they're talented people, they're professional people, they're working hard, they're trying to do best. So this certainly isn't an intention, this underperformance. But one big factor, of course, is the fees, and you can see here on this chart, the yellow line is the growth of 10,000 if the fees were the same as the Vanguard Balance Fund, and the red line is the actual fees. So you can see, even if the fees were the same, they're not keeping pace with balance. But when you include those fees, which are often close to 2% all in nowadays, that makes a huge difference, right? So even if you have alpha, so to speak, before you're taking into account fees, after the fees, you're net negative, right? And the hardest part for an investor is picking that fund in advance that does well. It's the same situation we talk about with equity funds or any type of funds in general. We see this chasing of performance. So if we look after 2008, people threw money at all these funds that did well in 2008, that shorted subprime securities, and they couldn't repeat that performance going forward. The other big issue that people have is that there's just so many hedge funds. So I put together this table here. There's now 15,000 hedge funds, Peter. There's more hedge funds than Dunkin' Donuts, Taco Bell's, Wendy's, Chipotle's, Chick-fil-A. There probably shouldn't be more hedge funds than Dunkin' Donuts. There's Dunkin' Donuts in just about every major area in the United States. There probably shouldn't be more hedge funds. And why this is a problem is competition, right? That arbitrage opportunity isn't there when it's arbitraged away by just the sheer number of funds doing exactly the same thing. So yes, some of them have these unique strategies, and there's certainly that fund out in Long Island where they've produced unbelievable returns, Renaissance fund, but that's not available to everyone. And they have like 100 something PhDs or all geniuses doing nobody knows what, right? But other than them and a few other people, many of them are following the same exact strategy. And of course, that's going to reduce the return that you get. So the idea for investors when they're looking for a hedge, what I like to tell investors were think about your exposure. If you need that hedge, let's say you're 90% long stocks and you're worried that there's going to be a bear market, and or worse, and you want to protect against that. Well, that's fine. You're probably better off rethinking that equity exposure, right? Replacing it with something more cash or some other security that has lower volatility in your portfolio rather than trying to pay up for that hedge for that lower correlation. Does that make sense to you, Peter?
To me, this whole thing's just hilarious. Imagine if you went to one of these, or if 95% of these 13,200 Dunkin' Donuts, you got sick every time you went. Like, that's basically the hedge fund world. There's 15,000, despite the fact that the vast majority of them underperform and charge you higher fees, and you pay higher taxes for the privilege to do it. To me, it's one of the very few industries in the United States where there's very little correlation between what you pay and what you get. And I think part of it's just so private. They're so quiet. Many of them are very small, that they're just not the easy way to compare things the way, say, an investor could with a mutual fund. That gets
Is it also, though, Peter, I mean, and you've probably been involved in this, where people just like to talk about being invested in something other than plain vanilla stocks and bonds.
For sure. Yeah, for sure.
That's shiny object. So they're using that. And there's always a hedge fund that's doing well and extremely well. And the fact that they could talk about that with their friends and others, that has to be driving a decent part of it. But it's still amazing to me that there is this many, at this day and age with all of the data that we have and ability to analyze it and see, in aggregate, it's not working. I guess it's just human nature to think, well, I'm going to be the exception to the rule. I'm going to pick that fund that's going to beat the rest, right?
Yeah, human nature.
No different.
And that's look, we need those things. That's part of why index funds perform, because you've got all these smart people on both sides of these trades, keeping the market as efficient as possible, which makes for the long-term investor who wants to play the odds, their costs are a lot lower because of these folks. So, I mean, even the passive investor is better off because of all these hedge funds.
Absolutely, right? So we should thank them in a way.
Yeah,
stay in business.
We appreciate you.
The liquidity is better. Spreads are better. It's better for it's better for everyone that's not invested in hedge funds. Okay, so let's talk about AI. And this is something that's not going away. I don't hear as many people. I think the ChatGPT thing has died down a little bit, but the idea that AI is going to revolutionize just about every industry is not going away. And with earnings, we're in the thick of earnings season now. You're going to hear a lot. We heard a lot last quarter. We're going to hear a lot more, I think, this quarter. And this was an interesting one, Peter, from the Motley Fool. They surveyed, I think, 2,000 Americans and asked them, have they used ChatGPT for stock recommendations? 47% actually said yes. This was a shocking number to me. Not because I don't think people would go to, if there's this idea that there's this intelligent thing out there, yes, naturally people are going to start asking it for stock picks, but for it to be that high, that really surprised me. And if we break it down by generation, I think it makes it more clear. It's the baby boomers are not embracing this as much as millennials, but the bottom table here surprised me as well, that high income people are embracing it more than other people. So people supposed to be more sophisticated, I guess, are thinking that this AI is going to give them the holy grail in terms of giving them these stock picks. So just before the video here, I jumped on Google's AI Bard and I asked, what will be give me the best 5 stock picks over the next month. And here we go. This is what it gave me, Peter. Apple, Microsoft, Google, Amazon, and then NVIDIA.
Yeah, of course. Yeah.
So very unique 5 stocks for the next month.
Yeah.
What do you make of this idea?
High multiple U.S. big tech centric picks. I love it. I think the 77% high income is probably a big factor, as only high income people, for the most part, have stocks. I mean, so those are the only people that might bother asking
Yep.
But look, I think this is another example of AI is going to have an impact on a lot of professions, including the financial profession, but it probably won't be stock picking. I think the way it will be used is you might have a thesis on what might outperform and be able to get AI to implement that thesis for you. And that will be the difference. Like you might say, if something meets these 27 criterias and is trending this way, I would like a screen of those stocks. I want it every day at this time. I think that's the kind of thing that AI is going to be able to help with, not
Hmm.
so much on its own picking stocks in an efficient market.
Yeah, agreed. Still a zero sum game. The AI
Right.
doesn't change that. And the idea that if there was a program, let's say that could predict it, and I'm sure all those hedge funds we just talked about, they've been doing this for years, and
Hmm.
certainly some of them are doing very well with it. They're not going to share that with the
Correct.
retail public for free,
Yeah.
and not even $30 a month is not going to get you there. And I doubt. I would be very skeptical, and I would encourage people to really be very skeptical that something it's going to spit out a stock pick that and it might work, right? So someone who probably a month ago would have told you those same five stocks, I'm guessing,
Right.
and if you had bought those five stocks or bought anything, it's higher today, and you would have said, "Wow, it's working." So it's also very difficult to kind of test these things to say, is it actually working or is it just chance or luck? So
Right.
be very careful and skeptical. But with other things, it's pretty clear AI is going to either replace a lot of things or enhance a lot of things, and it's not all bad, right? There's going to be parts of everyone's job that they don't like. It's rote work, it's data entry, it's things that are just time consuming that can be improved by this. Just simple customer service. We think about it, and you probably made many frustrating phone calls to telecom companies and other companies and had to wait for an hour to speak to someone over a very simple thing. And I'm thinking to myself, wow, that is the first use case that we should get. And they're still at this stage where they're asking you a million questions, and then you get a live person and they re-ask you those same questions, which is extremely
Mhm.
frustrating. But I don't think we're far away from them being able to solve the actual problem from you, because these programs, questions that we have are very similar, and these programs are built to do just that.
Yeah, I think it's going to be a game changer on everything from going through a fast food drive-through to dealing with medical records and medical diagnosis. I think it's going to revolutionize things that are day to day frustrating, like the fast food drive-through or the call
Yep.
center that you're referencing. But I think it's really going to be transformative for industries like healthcare, where we're going to just see such a better advice and better implementation, better understanding of prognosis and record keeping because of AI. And I think it's coming faster, really fast.
Yeah, you could just think about radiology and how
Yeah.
they'll use it. Not that they're not going to eliminate radiologists, but the fact that you're going to have a check and they can cross-reference immediately millions of different similar images and similar results. That has to improve, the outcomes for people in terms of
Yes.
assessing, is this a problem? Is it not a problem? Is there something there? Is not something there? And that's just one of many things. What do you make of the self-driving thing? Like, if so you've seen the videos. It seems, it's debatable whether it's there today, but it seems like it's pretty close to there. What's the point where you would actually trust this thing for yourself to get into your own self-driving car, or let's say an Uber that without a driver? What's going to make you feel comfortable ultimately, assuming that it passed all the regulations and everything else?
Right. I'd love to be on the cutting edge, but not the bleeding edge of that. So I mean, inclined to wait until at least 10 or 15% of the cars on the road are that way. But I think that world is coming fast. I think all cars are going to be electric, and all of them are going to be self-driving. And a car is going to take my kids to school, and then take me to work, and then leave work, and maybe go pick somebody up and take them somewhere else. And the car doesn't have to sit anywhere. When we were looking at building our headquarters, one of the things we were talking about was our parking lots, and do we need them, and how big should they be? Because eventually people won't be driving their cars to work. Their car will drop them off, and then one family might have one car, or you and your friends might share one car.
Mm.
And why would we need all these parking garages and parking lots? And so I think it's coming very, very fast. I think driving, we're going to see the fatalities on the road plummet. I think you're going to see traffic jams, go away completely or be horrible, depending on what happens. But for the most part, go away completely. I think it's going to improve our lives beyond what we're thinking about. once it happens. So I'm one of the. I cannot wait till I've got a lot of clients that are car dealers, and they're talking to me about how all these major brands or their whole lines are going to be electric within just a period of years. I think self-driving across the board there's going to be a tipping point where all just happens at once, just like that. And I don't think it's going to be that long, and I think it'll be very, very positive all around.
Yeah, I agree. But I agree with your sentiment that let's wait and see. I'll let other people test it out.
Right.
It's an unnerving feeling, I guess. The fact that I just can't picture yourself watching a movie or reading something, but just think of all the efficiencies also there, I guess,
Oh
that
yeah.
you can have. I mean,
Why would the cars even be laid out the way they are today? They may as well be set up as like mini offices or a bed or what, depending on how far you are from where you're going. You might take a different car that can do a different thing. Just hop in your car and lay down and
yeah,
take a nap. And I think the configuration will be the next thing to change. First you go electric, then you self-driving, and then the cars will just look completely different depending
yeah,
on the situation. I'm looking forward to all of that. I think that
same.
cars to me are they're one of the things I worry. As a parent, I worry about that more than anything else. And so to me, like this can't get solved fast enough.
The safety issue, I think, is going to really drive it. As you said, if we look at what's interesting is the last few years we've seen an increase in accidents, and I'm sure you've seen your own auto insurance. Certainly, in the case for me, everybody's is going up significantly because of that, and because cars are more expensive and used car prices have gone up. But the fact that accidents are going up, and part of that is also people on their smartphones and looking at them, the increase, how much more dangerous that is. And now the cars themselves have all these technological gadgets in there for you to be distracted with. So that part can't come soon enough. I don't know what that'll do to the insurance industry, but I don't really care. I mean,
Yeah, I know. They'll
let's
survive.
disrupt that. Yeah, right. Yeah.
Yeah, let's disrupt it.
Yes. Yeah. Geico has made enough profits for enough time, and Berkshire certainly got its money's worth already about that. But I think that'll be ultimately when they could kind of prove that as a tipping point, that'll be the driving force. Let's say, let's push it forward. But in terms of AI replacing everything, I'm not on the camp that's going to happen at all. Certainly not in the short term. There's many jobs that you could say, at least in the short run, we can't predict. Who knows how intelligent these things are going to become. But for now, jobs that require creativity or just social interaction, or what I would say emotional intelligence, right? Where you need another human being to show empathy, and maybe these things will show it, but at this point, I don't think we're there in terms of replacing these types of jobs. You have any thoughts in terms of, this has been the fear with every technology throughout the ages, that it's just going to replace all of the jobs and no new ones will come out, but every time before in history, we've been okay. Do you think that's the same, or do you think this is going to be
I think it's
game changer?
100% the same. All of these advancements in technology, they improve our quality of life, and the jobs that went away get replaced with better jobs. And so we can take it, whether we take the 8-track to the cassette to the CD to online music, or you take writing to from parchment to books to online books. Yes, certain jobs go away, but our quality of life gets better. We get more time back. Things cost less, and then we enter jobs that are better. Look at today. Despite all the advancements and all the technology, and we've had more advancements in the last 30 years than any time in human history, and unemployment is the lowest it's ever been since the United States recorded it. So I think there's a lot of evidence that quality of life gets better, and the cost of things goes down, and we still wind up having our jobs. We're just doing different things. And there's an interesting statistic that, I think around maybe 1880, 90% of us were farmers, right? And today, there's more output despite less than 5% of us being farmers. You can do the same thing with manufacturing. 50 years ago, 1 in 2 of us was in manufacturing, and today it's less than 10%, yet we in this country manufacture more. So technology has allowed us to produce more for less, meaning that what the consumer gets, they pay less for it, they get more, and their quality of life, improves. I think a simple example is, you used to pay to go to a movie, $20, and now you can pay Netflix. It was $10 a month or whatever it is, and you can have thousands and thousands of movies. You watch them whenever you want. You can pause them whenever you want, and you can watch them laying in bed if you want. Of course, you've got more things at your fingertips. You've got billions and billions and billions of dollars of content you can watch whenever you feel like it, because of the advancements in technology, And yeah, some people lost their jobs. Some movie theaters didn't survive, but they were replaced by jobs in the tech industry and the production industry that are delivering these things that are higher paying jobs. And that's just the general cycle of advancement for all time.
You can't stop it either. So
Yeah.
I don't. The alternative is to try to stop it or slow it down, but then you run the risk of falling behind. Right? If
Yeah.
so, the U.S. we want to be the leader in AI. So the idea that we should slow it down and let Europe or Asia take the lead, that's not a good thing either. So disruption is coming. It's certainly going to be painful, which is why really the best skill set most people can have is just being adaptable. Right? You're going to have to learn how to just because we have these AI programs doesn't mean immediately they're going to be easy to use or learn. That's going to be part of the skill set, and there's going to be a whole suite of jobs just learning how to manage this new technology. Because right now it's difficult, I think, for a lot of people to see. But speaking of that, see how they're going to use it. But speaking of that, Microsoft big announcement this week is Copilot, which is their AI assistant for all of the Microsoft products. So think about Word, Excel, Outlook, Teams, PowerPoint, all together, and it's all within your reach to ask it prompts and questions. So you're in Excel, you have this enormous database with numbers, and you could say and analyze this for me. Give me the top 5 takeaways from that, and it will immediately do that for you. You could go to your Word doc and say, create a presentation, a PowerPoint presentation based on this. You could go to your emails and say, create a prompt for the meetings, for a meeting of this group of people based on these emails, Peter. So this to me is a game changer. Obviously, all of the big tech companies are going to do this. We're going to see Apple do this. We're going to see Google do this, obviously, with all of their email and their products. Every big company's going to do this. Every company probably in general will do this, their own version of this. What do you make about this type of thing? And just you can imagine the productivity enhancements that this is going to lead to once people figure out how to use it. There's going to be a learning curve for sure. But once people figure it out, it's going to be pretty incredible, I think.
Yeah, I mean, I just remember when we started at creative planning, it was Excel spreadsheets that moved really slow on and if you were using the internet, it was dial-up. And the advancements with technology have allowed the same job to happen, but instead of taking 6 or 7 people to do something, it takes 1. It's just so much more efficient. And that's what this is going to do. This is just going to revolutionize advancements and efficiencies and allow less people to do more. And it's to me, this is far more exciting than even the internet, and in terms of like the revolution of really how far as a civilization we're going to be able to leap forward.
Yeah, that's pretty incredible. And just freeing up that time to do what's most meaningful, right? In your whatever job that is pretty awesome. To automate away the things that are annoying to you, but that still have to get done. This is going to be helpful with that. So let's embrace it and try to figure it out for sure. All right, let's talk about something fun here. How Taylor Swift is boosting the economy. This is pretty fascinating. The Philadelphia Fed, Peter, did a study. I don't know. I guess maybe they had interns around, or maybe they just it was a slow time over there. They actually did a study analyzing Taylor Swift's effect on the economy. They said it was pretty big. It could add $5 billion in economic value. I think that might even be an understatement. You're talking about her going around to all these different cities, and they're breaking records in terms of hotels and airfare. Everything coming in and out of these cities is just being boosted by Taylor Swift. I know that you might be a Swiftie here based on this tweet. The best entertainer in the world right now.
I stand by it.
I didn't look at the comments, but did you get people coming after you for that statement?
There's diverse opinion on that. I found. I've been to every Taylor Swift tour with my daughter since she was very little, and
okay.
I as she gets older, I'm gonna have to, when she outgrows this, I'm gonna have to drag her to these to keep using her as my cover. And she's an incredible entertainer, and from an economic perspective, her showing up to a town is just like having the Super Bowl in your backyard. I mean, it's the exact same thing. I mean, people are flying in from everywhere. There's a lot of demand for the tickets, hotels, restaurants, bars, shops. Everything gets this enormous boost. I think it's an understatement, despite the fact that I don't like the way economists do this. I remember when I was in college, I had music stores, and I had one in Kansas City. And every time the Chiefs would play, the Kansas City Fed or somebody would say, well, this is what the chief said of the economy because they do all these things. But I knew
Yep.
that when I worked Sunday in my music store, sales were down 90%, right? Because everyone was at the chief. So they count all the dollars for the hotels, the restaurants, and the bars, but they don't count all the dollars lost at the shopping malls and the strip centers and all the zoo and everyone else that's doing something else at the same time. So I think they probably understated the revenue from Taylor, and I'm sure, as economists always do, they left out all the other costs that happen along the way. It's a great case study, though, of economics. I used her as an example to talk to my kids about capitalism, too. If you look at, like, the thousands of people that are involved in her art sets, her production, dancing, her road crew, her travel, her pilots, all of those people put together will make less on this tour than Taylor Swift. I mean, if you are that talented and that unique, you will get disproportionately rewarded. She's a classic example of that. It's sort of like if you see a movie with Jennifer Lawrence in it, she's making more money than all the cast and crew and directors and producers put together usually. And that's just how the marketplace works.
Yeah, it's incredible. I think I read that it's expected to gross more than $1 billion, and her share of that is going to be probably more than 50%, which is unheard of. So she's gonna gross 500 million from this tour.
So I think first of all, much more than that. I think normally they get like 90% of the gate, and I think she will. I don't think it's going to cost that many hundreds of millions to pay everybody else on the tour. It wouldn't surprise me if she was pocketing 70%. I also think what's amazing is she underselling the price of her tickets. I mean, her average ticket is selling for 200 or 300% more than what she's releasing it for, which means the people that are making the most money are the resellers in aggregate. And so it's crazy. If she used dynamic pricing or really sold her tickets at fair market value, the revenue would easily be 2.5 to 3.5 times higher.
Right, but then she would lose that image of being for the everyday person. It's just you're right. It's a tough. And in New York here, she did 2 or 3 shows. They all sold out. It was in Jets Giant Stadium here in the Meadowlands. You're talking about huge number of people there. And the average resale is talking about $1,000 a ticket, right? I don't know what the original price was, but maybe $100, $200. It could be even less than that. So you're right. If it was all of that additional economic value is going to these other people, but for now she's doing okay. She's not doing too bad, and as we said, she might be the first to go over $1 billion. And a big part of this, I don't know if I'm sure you experienced. Did your daughter buy merchandise in there? They said that the average person spends $50 to $75 per person at this concert, which is just an additional thing. I'm sure you got one as well.
Oh yeah, the merch line was like an hour by itself. Yeah, it was a big commitment just to do that,
and probably sold out everything there. Yep. And there's demand for that as well. Okay, so here's the question, Peter. It's expected to be now the biggest grossing tour of all time, the Taylor Swift tour, over $1 billion. These are the top 10 today. How many of these top 10? I know you're a big music guy. How many of these top 10 have you been to?
All right, I've been to 5 of them. Elton John, I'm giving that a B. Ed Sheeran, I didn't love it. I'm not going to lie. I know he's one of the most popular people in the world. That was also with my daughter. U2, always a fan. Yep. Last tour, a little tough to get through, but other than that, it was great. And Coldplay, A++. I'd give it an A++ if I could. And AC/DC, I'd give it A+ too. Now, here's what's interesting about this list to me is the Elton John tour went on for like ever. I mean, 4 years with a little bit of a 1-year break or 2-year. I mean, like Taylor Swift is breaking the record with way more shows than any of these artists. It's not just that she's going to pass them all. It's that she's doing a small fraction of the shows they were doing. If she was doing as many shows as Elton John did, she'd gross $5-6 billion.
Good point here. It's not adjusted for the number of shows. So per show, she's the best. Okay, so you've been to 5 out of. Never seen the Stones?
I've never seen the Stones. I remember even when they toured like in the 90s, I'm like, God, they've been around a long time. They've been pretty old. So somehow I've missed them all the way.
Okay. And all the way I think they're done now, right? Or no, who knows?
I really doubt it. Yeah, I really doubt it.
Okay. Good. We'll see them back. Let's talk about summer reading here, Peter. This was a good one last month. A lot of people appreciated it. So let's do some more here. You could start off here. Happiness Advantage. That sounds pretty pretty good advantage to have. Tell us about the happiness advantage.
So we had Sean speak at our annual meeting we have every September for our clients, and he's a speaker on happiness. He's done a lot of research on it, and he was absolutely fascinating. I read his book right away, and it's just fascinating to see like what goes into happiness, how much of it you can control through your disposition, what comes into your mind, what you listen to, what you read, what you think about, what you allow yourself to think about. But the biggest thing was the emphasis on social connections and how important that is. It doesn't almost doesn't matter who the social connections are with, just that you have some kind of meaningful relationships with certain people that you can count on throughout your life. That seems to be the biggest driver of happiness. You add a little bit of physical activity into it. There's a lot of other things, but looking at the recipe is really, really interesting. That what the emphasis is really on social connection and some kind of modest exercise of any kind, and you put those two things together, and you're 80% of the way there. How about you, Charlie? What do you got this week?
Awesome. That's a good one. I'm going to check that out. Crashing Through. Ever read Robert Kurson? Great
Never.
author. He's written a bunch of great books. This is one of my recent favorites. It's about a guy named Mike May. At 3 years old, he goes blind through a chemical accident at his house, and he goes through life essentially blind and does amazing, incredible things. He becomes like a skier, which is incredible. I have a hard time skiing. Being able to see, I don't know how he did that. Became like a championship skier. He went on to be an entrepreneur, did many, many things was a wrestler, did many things that people never thought that he could achieve. And for all intents and purposes, he lived a very happy life, got married, had 2 kids. And then just by this chance encounter, he comes to understand that there's this new surgery that he could do where there's risk to it, but if he does it, he could be able to see again. And he's in his 40s at this point, and never remember even seeing because he was 3 years old. So I won't give away what happens, but it's just a really interesting thing. I think the biggest takeaway for me was that it wasn't a no-brainer, the decision. So yes, there were risks involved in terms of what could go wrong, but it wasn't just that we all assume that if you were blind, you definitely want to see again. But there was only a handful of people before him who had complete blindness and then went on to be able to see again. And without fail, all of them had these severe emotional problems thereafter.
Wow.
And they talked about, I won't give it away, talked about some of the reasons for that. But one of the big reasons is, and you wouldn't think of this, is in their head, they're picturing their whole life, everything to be perfect. Right? Like the corners on buildings and just how everything looks, and people are all beautiful. And when the reality of that wasn't the case, that was very hard for people to understand. And there was this other aspect as well, that a lot of your vision is formed by memory in your first 5 to 10 years of life. And when you don't have that benefit, it's difficult to have like a full visual perspective. And because it's not just the actual physical attributes of the eye, everything could be working fine, but if you don't have that built up memory to identify, let's say, an elephant as being an elephant, you have a description of it, but it's not the same thing. If you don't have that, it becomes difficult. So anyway, check it out. Very, very interesting. Really, really a story that's an uplifting story, and really makes you think about a lot of things that go on in your everyday life, and a lot of things we take for granted, obviously being able to see. But let's go signal or noise here, Peter. This is the bond yield that everyone talks about in the world. They've said it's the most important yield, bar none, in financial markets. 10-year Treasury yield is currently at 3.8%. You can see it's been a lot higher. It was lower in 2020, much lower, almost 30 basis points at the low. But what do you make of the 10-year Treasury as a signal? We're going to break this down in 2 parts. I'll let you take the bond market, and then I'll talk about the stock market as a signal or noise for bond market investors.
I think the short term is worthless in the bond market, and the long term is usually a pretty good signal. I very rarely say something could be a signal, but the long term is a lot of money betting on things going a certain way for a long period of time, and it's usually somewhat predictive of what's going to happen in the markets. How about you?
Yeah,
what's your take on bonds? Before you give me your take on stocks, what's your take on the bonds?
Yeah, so my take on bonds is it's simple math. So in the short run, like you said, it's worthless because it's the change in interest rates that drives the short-term price of a bond, right? And we saw that to the extreme last year when interest rates rose, the price of the bond goes down. But if you hold that bond to maturity, well, what are you going to receive? You're going to receive that coupon on the bond plus reinvestment of that interest. And most of the time, there's an extremely high correlation, over 90%, between that starting bond yield and what you receive over the lifetime of that bond. And here you can see it's pretty linear. When bond yields were over 10%, investors receive a high return on bonds. In recent years, when bond yields are very low, and we don't even have the 7-year data from 2020, we'll get that in 2027.
Right.
It's not going to be pretty in terms of bonds. So very much a signal for long-term bond investors. And the good news, we're up to 3.8% today. You have short-term bond yields even higher than that. The good news is the future 7-year returns today are going to be much, much better than they were a few years ago. So not anywhere where we were in the 1980s, but pretty good
Right.
if you're a bond investor versus a few years ago. The stock market, though, Peter, as you know, very different animal. And for all of the noise that you hear about interest rates being so important to stock market returns, and people make these simplistic claims that, oh, if interest rates are low, that should be awesome for stocks. And if interest rates are high, that should be terrible for stocks. The data simply does not bear that out. If you look since 1976, we've actually seen the best future stock market returns following very high interest rates. And when did that occur? In the early 1980s. But very low interest rates, not bad for stocks. It just really doesn't matter. As you can see there's no consistent pattern. Actually, if you look at the correlation between bond yields and stock market returns, it's essentially zero. And that might be surprising, but it's also the reason why there's value to having bonds in your portfolio if you're a stock market investor, because they don't move on the same thing. Bonds are driven by interest rates, and stocks are driven by obviously earnings, but many other factors as well, most important being sentiment. And especially in the short run, but even over a 7-year period, sentiment's going to drive a big part of that return. So if you're a stock market investor, 10-year yield means almost nothing. And a lot of people will tell you otherwise, but I don't. The data really doesn't bear that out. It shows you that it's noise. Now, I want to come back and talk about the last 7 years here in terms of what the stock market's done, what the bond market's done, what a 60-40 portfolio does. So a lot of talk, Peter, about 60-40 portfolios dead and all this and that. It's done about 6.8% over the last 7 years. Not bad at all. Stocks have done actually over 10% the last 7 years. Very good. What's the outlier here? It's bonds, 0.5% a year over the last 7 years. And why did that occur? Because 7 years ago, in 2016, interest rates were extremely low. You had a 10-year below 2%, right? So predictive for bonds, not predictive for stocks. And if you look at interest rates today, same thing going forward. I would make the same claim. And I want to end here, Peter. Don't fight the Fed. Remember that. We covered that a few signal or noises ago, and we talked about this in terms of the Fed funds rate. And the Fed's going to hike again next week, and you're going to have the same people saying, don't fight the Fed, don't fight the Fed. Was this shocking to you whatsoever? The S&P 500 is now 5% higher than where it was on March 16, 2022. What happened that day? That was the day the Fed started hiking interest rates, moving above 0%. Does this surprise you as an investor whatsoever?
It doesn't surprise me because I think we can never to your point, you can never tell based on the Fed what's going to happen with the markets. But I would say the Fed has had an impact on stocks, particularly small stocks, and really we have a large cap technology sector that has gone soaring regardless of what's happening with rates. That's what has lifted the S&P 500 up. But if you look at the other indexes, I think the Fed has contained the market enthusiasm a little bit. It's one of the main factors that's there. But this is just proof you cannot make predictions based on what the Fed's doing, and it doesn't matter where interest rates are.
Yeah, and more than that, it's you can't take it in isolation. Like that's the thing. So let's say everything else was equal tomorrow, and the Fed funds rate was cut to 2%. Yeah, that would be good. I would agree with that. But everything else isn't equal. The Fed's not going to cut rates that aggressively, that quickly, unless something is very, very wrong in the economy. So you actually don't want to see that, because that would be worse for the stock market. So it's a complicated animal. But coming back to that table here, this is the most important things for investors to focus on. The fact that it's not the Fed funds rate that matters, real or nominal, so how tight or easy. The market tends to go up regardless of that. It's your time in the market. So just going from left to right, if you stay invested 3 years versus 1 year, you're likely to have a bigger gain. 5 years versus 3 years, same thing. 10 years versus 5 years, and on and on and on. The best thing you can do to increase your odds as an investor is just think long term, regardless of what the Fed is doing. And there's going to be a lot of noise with the Fed in the next year for sure, but just try to ignore that if your horizon is a long one. And even if it's a short run, as we've seen, you can't really predict that either.
100%. The stock, the one thing that's always noise is everything related to the stock market is pretty much always noise. Everything's priced in. The market's not perfectly efficient. It's close enough that it's not going to be outsmarted on a repeatable basis by anybody. Another great example of just noise.
Awesome. All right, Peter. So let's end it right there. Everybody, thank you for joining. For more content, subscribe to the channel. Remember, if you're watching this on YouTube, we're also available on all the podcast platforms, so check us out there as well. And we'll see you next time on Signal or Noise.